Welcome, curious minds, to another deep dive. Today, we're jumping straight into a scenario that, frankly, would probably make most traders just freeze. Imagine this. You see a stock, right? And before the market even opens, it's already gapped up, not just a little bit, 8%.
8% pre-market is huge, absolutely massive.
Right. People are buzzing, they're watching their screens, probably thinking, okay, this is it. This is the one going to the moon. But then the opening bell rings. And those first few minutes, wow, that hope, it doesn't just fade. It completely vanishes. The stock doesn't just dip. It actually crashes, 10% down from where it opened. What looked like a sure thing turns into, well, a nightmare for a lot of folks.
A classic bull trap scenario potentially unfolding right there.
Exactly. But here's the twist. What if I told you there was one trader, an intraday specialist, Prodi, who didn't just watch this happen? He actually anticipated this exact violent reversal. And not only anticipated it, but executed a trade during it. Nailed it. Live.
That's not luck, that's skill.
Absolutely. It's this incredible mix of sharp observation, strict discipline, and really fast, but calculated decision-making. So our mission today, we want to unpack those moments, the key decisions, the sort of psychological strength it took to navigate that chaos. We're looking for those nuggets of knowledge, the insights that apply, even if you never look at a stock chart. Lessons for anyone making high-pressure decisions.
That's spot on. And our source for this really fascinating deep dive, it comes straight from an interview transcript with Pradi himself. He walked through the entire trade, start to finish, how he saw it setting up, the crazy opening minutes, right through to taking profit. And, looking at real-world cases like this, especially in volatile situations, it's just invaluable. It takes us past the theory. We see concrete examples of, like you said, observation, strategy, and keeping your cool under fire. It's not just about trading stocks. It's about how you read signals and act decisively anywhere.
Okay, let's dive in. So the story starts before the market even opens. Purdy sees this stock, already up 8% pre-market. Now, most people, they see that, and boom, FOMO kicks in, fear of missing out. They're thinking, gotta get in, it's going higher.
Instinctive reaction for many.
But Purdy, his first thought was different. Why? He actually noted, and this is a quote, "Too much hype? Let's see if this is sustainable."
That's pretty counterintuitive, right?
It is, and it's incredibly telling. What's really fascinating is that his immediate reaction wasn't greed or excitement. It was skepticism, a pause, an 8% gap up pre-market, especially without major breaking news. That's a huge, huge move.
Yeah.
Often that signals the market is running on, well, pure enthusiasm, hike. Think of it like a balloon inflating really fast. Looks impressive, sure, but you have to wonder what's actually filling it and how much more air it can take before it pops.
These big pre-market jumps, they act like magnets for what we call uninformed buyers. People see the price rocketing, feel that FOMO, and jump in without really understanding the structure or having a plan. They just assume the trajectory continues, up, up, up. Exactly, chasing the price. And the risk, which Curdy clearly understood, is that if that initial buzz fades, or worse, if the big players, the institutions, see it as a golden chance to sell at high prices, then those late buyers get trapped, right at the top, leading to those sharp, painful reversals.
Ouch.
So Purdy's thought, too much hype. Let's see. It shows that deep experience. He knows extreme moves built on hype often aren't sustainable. They might even set up a move in the opposite direction.
But even with that skepticism, he wasn't immediately bearish, right? He said his initial bias was neutral to bullish. Yet he stressed, I never jump in blindly. That seems like a really fine line to walk. Having a leaning but refusing to act without proof. How hard is that discipline, and why is waiting so vital, especially when things are moving fast?
Oh, it's incredibly difficult. It's probably one of the hardest disciplines to master, honestly. In trading, or really any high-pressure decision field. Think about it like a detective. They might have a gut feeling, a hunch about a suspect that's their neutral to bullish bias, maybe.
Okay.
But they don't just rush out and make an arrest based on that feeling, do they? No. They wait. They gather evidence. The hunch guides the investigation. It doesn't dictate the action.
That makes sense.
Many traders, especially less experienced ones, see that huge pre-market jump and feel this overwhelming urge to get in now. If I wait, I'll miss it. That's the emotional trap. FOMO, impulse, it takes over. They skip the analysis and just act on that gut feeling, often buying right at the peak.
Right, when the smart money might be thinking of selling.
Precisely. Brady's approach shows that a bias is just a starting point.
Yeah.
Hypothesis. You need the market itself to confirm or deny it through price action, through volume, entering blindly. Without those cues, it's like going all in poker before you've even seen the flop. It's usually driven by emotion, not strategy.
So you risk getting wiped out fast.
Absolutely. By waiting for real evidence, Preddy positioned himself to react to what the market was actually doing, not what he hoped or feared it might do. That patience. It's a superpower in volatile markets. Saves capital, saves emotional energy.
So he's patient, watching. What did he actually see then after the open that flipped his view from that cautious, neutral to bullish to thinking, okay, this might actually reverse hard? He said he was watching how the first few candles form, and that's when the story changed. Talk us through those critical first minutes. What are those opening candles telling an intraday trader?
Yeah, those first 5, 10, 15 minutes after the opening bell, they can be chaotic, sure, but they're also incredibly revealing. All the orders that built up pre-market from everyone, institutions, retail, they all hit the market at once. Big surge in volume, often big price swings. It's like the chaotic start of a race.
Everyone jostling for position.
Exactly. And the shape of those first candles, the price action, the volume, it's like a real-time report from the battlefront between buyers and sellers. Is the pre-market hype carrying through with real money, real conviction? Or are sellers stepping in immediately, absorbing that initial buying?
So it's not just price, it's the force behind the price.
Precisely. Are buyers aggressively pushing higher with strong volume, or is the buying weak easily pushed back? Those initial candles are the market's first real test of that pre-market sentiment under live fire.
You mentioned relating this outside trading, like the first few minutes of a project launch.
Yeah, think about that. You have an idea, lots of excitement, the pre-market hype. But once you launch, what do those first candles show? Are people actually using it, engaging deeply?
Or is it just a quick look and then they move on?
Right. Are your assumptions being confirmed by real behavior, real volume of interest? Or are you hitting unexpected resistance? Those immediate reactions are pure, unfiltered data about the underlying strength.
And in this case, what Purdy saw wasn't strength. It wasn't a continuation of that rally.
No, quite the opposite. Around 5 minutes after the open, he saw a very specific, very potent signal. He said, around 5 minutes in, the stock hit resistance and formed a bearish engulfing candle with increasing volume.
Okay, let's break that down. Bearish engulfing candle. What does that look like and what does it signal?
So visually, a bearish engulfing candle happens when you have a smaller up candle, often green or white, followed immediately by a much larger down candle, red or black, that completely engulfs the body of the previous up candle. It looks like the big red candle just swallowed the little green one.
Okay, I can picture that.
And what it signifies is a powerful shift in momentum. The buyers tried to push the price up, the small green candle, but then the sellers came in with overwhelming force, the big red candle, not only stopping the rise, but aggressively pushing the price down well below where the previous candle started. It screams reversal. Sellers have taken control.
And you mentioned it formed near resistance. Why is that location important?
That's critical context. Resistance levels are price areas where the stock has struggled to climb higher in the past. Think of it as a ceiling where sellers tend to show up in force. So when a stock hits a known resistance level and forms a strong reversal pattern like a bearish engulfing candle right there, that's a double whammy. It's the market hitting a wall and immediately showing signs of a retreat. Highly significant.
Okay, and the final piece, increasing volume. You mentioned volume earlier, how Purdy called it the only truth. Why is increasing volume on that bearish candle so crucial for confirmation?
Because volume measures participation, conviction. Price can move on low volume, maybe just a few players pushing it around. It can be deceptive.
Like noise, maybe.
Exactly. But when you see a powerful reversal pattern like that bearish engulfing candle, and it happens on increasing volume, that tells you a lot of shares are changing hands. It's not just a small group selling. It indicates broad participation in the selling. Maybe institutions are unloading. Maybe lots of earlier buyers are scrambling to get out. It confirms that the shift in control is real, powerful, and supported by significant market activity.
So the volume validates the pattern.
Absolutely. High volume on that bearish candle lends massive credibility to the reversal signal. It confirms the weakness is genuine and has momentum. Without that volume confirmation, the pattern itself is much less reliable. It might just be a blip.
Got it. And Brady's interpretation of this whole signal resistance bearish candle high volume was blunt. He said it screamed trap for retail buyers. Can you explain that concept of a market trap? How do those early buyers get caught?
Yeah, a trap is when the price action initially looks like it's confirming one direction, sucking traders in, only for the market to whip around violently in the opposite direction.
Yeah.
In this case, the trap for retail buyers refers to everyone who bought into that pre-market hype or maybe chased the first little move up after the open. They were driven by FOMO, seeing the price rise, believing the story.
They thought they were getting in on a rocket ship.
Right. But when the stock hits that resistance and the big players start selling into that retail buying pressure, which is what the bearish engulfing on high volume suggests, the dynamic flips. The sellers overwhelm the buyers. The price starts to fall, often very quickly. Those who bought near the top are instantly underwater. Their profits vanish, turn into losses. Stop losses get triggered. Panic selling might kick in.
Creating a cascade effect downwards.
Exactly. They bought high, lured in by the hype, and now they're forced to sell low. That's the trap. Prady recognized the setup for that trap before it fully sprung.
And the broader lesson there: be wary of hype without substance.
Absolutely. Be incredibly cautious when you see explosive growth driven mainly by excitement, not solid fundamentals or confirmed participation. Whether it's a stock, a new tech fad, whatever, if you don't see the volume of real commitment behind the price action, you might be the one left holding the bag when the hype fades. Always question the narrative.
Okay, so the signal is clear, the trap is identified. Now, the execution. Prady acted decisively. I entered right after the bearish candle closed. That timing after the close seems really specific. Why not jump in while the candle is still forming if it looks bearish?
That's a critical point of discipline. Waiting for the candle to close provides confirmation. While a candle is still forming, anything can happen in the last few seconds. It might look like a strong bearish engulfing midway through, but then a sudden wave of buying could come in right before it closes, changing its shape completely, maybe turning it into something indecisive or even bullish.
Invalidating the signal.
Exactly. If you enter mid-candle, you're acting on incomplete information. You're anticipating, not confirming. By waiting for the candle to close, Prady knew definitively that sellers had won that specific battle for that time period. The signal was locked in. It's about letting the market finish its statement before you commit.
That makes sense, like waiting for the final whistle in a game before celebrating.
Good analogy. And it applies elsewhere too, right? In a negotiation, you don't act on a potential concession until it's actually agreed upon, finalized, closed. You wait for the confirmation.
Okay, entry confirmed. What about managing the risk? This is where things often go wrong for people. He said, place my stop loss just above the high of that candle, tight and efficient. And then the risk reward was awesome. Talk about that stop loss.
The stop loss is non-negotiable for disciplined trading. It's your safety net. It's an order that automatically gets you out of the trade if the price moves against you to a predetermined level. Its main job is to protect your capital. Define your maximum pain point before you even enter the trade.
So you know exactly how much you stand to lose if you're wrong.
Precisely. And placing it just above the high of that candle is strategically brilliant. That high point represents the peak of the failed buying attempt, the point where sellers took definitive control. If the price were to rally back up above that high, it would mean the bearish signal failed. The sellers couldn't hold the line. His reason for the trade would be invalidated.
So the stop loss isn't just random. It's tied directly to the trade thesis.
Exactly. It says, if the price goes here, my analysis was wrong and I need to get out with a small controlled loss. It's efficient because the distance between his entry, just below the candle, and his stop, just above it, is relatively small. Tight.
And that leads to the awesome risk reward. How does the tight stop create that?
Because his risk, the distance to the stop loss, was small and clearly defined. But the potential reward. Given the context, the failed gap up, the strong reversal signal, the potential for trapped buyers to panic, the potential downside move was significant. Awesome risk reward means the potential profit was likely several times larger than the potential loss. Maybe he was risking $1 per share to potentially make $3, $4, or even more. That asymmetry is what professional traders look for. You don't have to be right every time if your winners are significantly bigger than your losers.
Got it. Risk a little to potentially make a lot.
That's the core idea. Define the risk first, ensure the potential reward justifies taking that risk. It's fundamental to sound investing, business strategy, everything.
So the trade is on, stop is set. How did it play out? He mentioned aiming for the VWAP blank, and once that snapped, it just kept falling. He said it was fast, almost vertical. What's VWAP and why is breaking it such a big deal?
All right, VWAP stands for volume-weighted average price. It's a bit different from a simple moving average because it factors in volume at each price level, so it gives more importance to prices where lots of shares traded. Many traders see it as a kind of fair value price for the day based on where the real action has happened. It often acts as a key intraday support or resistance level.
Like a magnet for the price during the day.
Sort of, yeah. When a stock is trading above VWAP, it's generally seen as bullish for the day the average participant is in profit. But when it breaks below VWAP, especially decisively, like Brady said it snapped, that's a strong bearish confirmation. It means the current price is now below the average price where most of the day's volume occurred. A lot of buyers are now underwater. It often signals that sellers have gained broad control and the path of least resistance is down.
So breaking VWAP was like opening the floodgates.
Often, yes. It confirmed the weakness seen in the initial reversal pattern was now translating into broader selling pressure across the market participants for that stock. The almost vertical fall showed just how intense that selling became once that key level broke.
And as it was falling, he didn't just sit there glued to the screen praying. He had a profit-taking plan too. I scaled out in parts, secured profits, and held a small chunk to the last leg. This seems like managing the win, which can be as hard as managing the loss.
Absolutely. Managing a winning trade effectively is a hallmark of professionalism. Greed can make you hold too long. Fear can make you exit too soon. Scaling out is a brilliant way to balance those. It means he didn't sell his entire position at one price target. As the stock dropped and hit certain levels, maybe predetermined support levels or based on the move's momentum, he sold off portions, say 25% here, another 25% lower down.
Locking in gains along the way.
Exactly. He secured profits. Took money off the table. This guarantees he walks away with something, protecting against a sudden reversal that could wipe out all his paper gains. It combats the letting a winner turn into a loser problem.
But he didn't sell everything at once.
Right. By holding a small chunk, he kept some skin in the game. If the stock continued to plunge further, that small remaining piece could still generate significant extra profit, maximizing the potential of his correct analysis without risking all the gains he'd already locked in.
So it's a balance, take profits, but let a portion run.
Precisely. It's a structured way to manage the emotional tug-of-war between greed, wanting more, and prudence, protecting what you have. It optimizes the outcome. It's smart risk management even when you're winning. Think about taking some chips off the table in poker when you're way ahead.
That makes a lot of sense, but still, being in a trade, moving that fast, almost vertical, even if it's going your way. The emotions must be intense. Excitement, maybe fear of it reversing. How did he handle that? He said, I've trained myself to trust the plan. I wasn't greedy. I knew my levels.
And that right there is the psychological core, isn't it? In high-stakes, fast-moving situations, emotions are your biggest potential enemy. Greed whispers, hold on, it'll go even further. Fear screams, get out now before it reverses. Both can lead to terrible decisions that sabotage a good trade or a good strategy in any field.
So the plan is the antidote.
The plan is the anchor. Having a predefined plan, knowing your entry criteria, your stop-loss level, your maximum pain, and your profit-taking strategy, your levels, like the VWAP break and scaling points, provides an objective framework. When volatility spikes and your heart starts pounding, you don't have to rely on gut feelings or react to the noise. You refer back to the rules you set when you were calm and rational.
Takes the guesswork out of it during the heat of the moment.
Exactly. You execute the plan. Knowing your levels beforehand removes the ambiguity that feeds emotional decision-making. It allows you to act based on your analysis and strategy, not on the euphoria of profits or the panic of a pullback. This applies everywhere. Business leaders facing a crisis, emergency responders, athletes in a championship game. Having a clear plan, practiced responses, defined boundaries, that's what allows for cool-headed execution under pressure. You design your response before the crisis hits.
And then he mentioned something else, almost casually, but it feels huge. Journaling trades has helped me handle emotions better than any indicator. Not a fancy tool, just writing things down.
Yeah, that's pure gold. And it's so often underestimated. Journaling isn't just about logging numbers. It's about active self-reflection. It's metacognition, thinking about your own thinking. When Prouty says it helps with emotions more than an indicator, he's acknowledging that often the biggest obstacle to consistent success isn't the market. It's the person trading it, your internal state.
How does writing it down help with that?
Because it forces you to systematically review not just what happened, but why. Why did I take this trade? What was I feeling? What were my thoughts? How did I manage it? What was the outcome? You create this detailed feedback loop. You start seeing your own patterns. Oh, look, every time the market does X, I tend to feel Y and make mistake Z.
You become aware of your own biases and triggers.
Precisely. You see, when greed crept in, when fear caused you to deviate from the plan, it makes it objective. A losing trade isn't a personal failure, it's data showing a deviation from your process. By consistently reviewing this journal, you can consciously develop strategies to counter your emotional pitfalls. You learn to trust your plan, your process more than your fleeting feelings. It builds resilience, refines strategy, it's self-coaching.
Like athletes reviewing game film to see their mistakes and successes.
Exactly the same principle, and it applies to anyone wanting to improve as skill leaders, reviewing decisions, writers, analyzing their process, anyone learning anything complex. That structured self-reflection is incredibly powerful.
Okay, so let's bring it all together. What does this mean for you, the listener? Whether you're looking at markets, projects, opportunities, anything that suddenly looks incredibly hot. Purdy offered 3 core pieces of advice. First, don't chase the hype.
That's number one, and maybe the most important. It directly tackles FOMO. When something explodes in popularity or price, that emotional pull to jump on board is intense. You see others seemingly winning and you fear being left out. But as Pretty's trade shows, chasing that initial burst without confirming its substance is often how you get caught. The hype peaks right when the uninformed are piling in, often just as the smart money is quietly heading for the exits.
Applies way beyond stocks.
Oh, absolutely. Chasing the latest tech trend without understanding it, jumping into a business fad without due diligence, even adopting a management style just because it's popular without seeing if it fits your context, resists the urge to follow blindly. Pause. Question. Is it real value or just temporary excitement?
Good advice. Number 2 from Preddy. Look for reversal patterns near resistance. Again, this sounds like it applies more broadly, too.
It does. It builds on the first point. Once you've resisted the chase, you need to know what to watch for. Identify the natural resistance levels for whatever trend you're observing. Where might its growth logically slow down or face challenges? Resource limits, market saturation, valuation ceilings. Then, as the trend approaches these potential ceilings, you actively look for reversal patterns, signs that the upward momentum is weakening. In trading, it was the bearish engulfing candle. Elsewhere, it could be slowing user growth, rising customer complaints, key team members leaving, negative data points starting to emerge despite the positive spin.
Signals that the narrative might be changing.
Exactly. Patterns that suggest the initial assumptions might be wrong, and a change in direction, a slowdown, or even failure could be coming. Be ready to adjust your view based on evidence at these critical points.
And his third piece of advice. Respect volume, it's the only truth. This feels like the ultimate reality check.
It really is, because price or surface level buzz can be misleading. A stock can go up on low volume. A trend can seem popular because a few loud voices are promoting it. That's low volume, weak participation. But volume, as Prady emphasizes, shows the real conviction. Was that stock gap up supported by huge numbers of shares trading hands, high volume, real interest? Or was it thin, low volume, maybe a setup for a trap? When that bearish engulfing candle formed on high volume, it meant many participants agreed the direction was changing. That's a reliable signal.
So in life, look for the real engagement behind the noise.
Precisely. Is a project getting real resources and commitment, high volume, or just talk? Is a new initiative seeing genuine widespread adoption or just superficial interest from a few? Respect the underlying level of true participation and conviction. It separates substance from hype.
Wow. So those 3 together, don't chase, watch for reversals at resistance, and respect the volume. It's a whole strategy, isn't it?
It's a complete, disciplined framework. It's not about predicting the future. It's about preparing, observing patiently, identifying key signals, patterns and volume at critical levels, resistance, and then acting decisively based on that confirmed evidence. It works for navigating markets, business decisions, personal challenges, anywhere with uncertainty and volatility, observation, patience, discipline.
What a fantastic breakdown of that trade. It really drives home that success in these moments isn't just luck. It's this blend of observation, technical skill, and that crucial psychological strength. It shows that these extreme moments, they often give off signals, subtle maybe, but powerful if you're prepared and disciplined enough to see them and act on them, not on your emotions. And as we wrap up, that final thought from Prady really resonates, tying it all together. The best traders don't predict, they prepare.
That nails it. Success isn't about guessing. It's about the hard work of preparation, having a plan, knowing your tools, mastering your emotions, and being ready to execute when your prepared signals appear. And that principle, it's universal. CEOs planning strategy, engineers designing systems, athletes training, students studying. You don't try to predict every outcome. You prepare for different scenarios, you know your key indicators, and you execute your plan with discipline. So the question for you listening is this: how can you apply these ideas, rigorous observation, disciplined planning, emotional control, to your own challenges, your career, your learning, your decisions? What signals might you be missing in your own first 5 minutes, those crucial opening moments of anything new? Are you getting caught up in hype? Are you ignoring signs of resistance? Are you respecting the real volume of commitment? Thinking about that could change your story.
Powerful questions to ponder. And if you do want to explore more of Purdy's insights on price action, how he breaks down trades, you can find him sharing his knowledge on his YouTube channel at Creedle Learner. It's a great resource for continuous learning. Until our next deep dive, stay curious, keep digging for those nuggets of knowledge, and remember, preparation is power.